Today, September 17th, 2025, marks a date that could have a real impact on your financial life, whether you're paying off debt, saving for a big goal, or just trying to make ends meet. It's a turning point for your money and for the way you plan your financial future. The Federal Reserve, often called the Fed, sets the interest rates that ripple through every part of your financial life, from the loans you take out to the interest you earn on your savings. When the Fed cuts rates, borrowing money gets cheaper. That means your credit card payments, your mortgage, your car loan, almost every kind of debt can cost you less each month. After 9 months of steady rates, the Fed is expected to announce a rate cut, a move that's been highly anticipated by markets, businesses, and everyday people alike. But this isn't just a headline for Wall Street or economists. It's about your wallet, your family's budget, and your plans for the future, whether that's buying a home, starting a business, or simply saving for a rainy day. Lower rates mean it's easier to borrow, which can help you afford big purchases or refinance existing debt. But there's a flip side. The money you keep in savings accounts or CDs might not grow as quickly, since banks often lower the interest they pay you. The Fed's decision is also a signal, a message about how they see the economy's health right now. Are things slowing down? Are they trying to encourage more spending and investment? Their move tells us a lot about what's happening behind the scenes. For many, a rate cut can open the door to homeownership, making it easier to qualify for a mortgage or lock in a lower rate on a new loan. It can also ease your debt burden, freeing up money in your monthly budget for other needs or goals. But if you're relying on interest from your savings, you might notice those returns shrinking, making it harder to grow your nest egg. Understanding these changes is the first step to making smart financial moves. It's about knowing when to borrow, when to save, and how to adjust your plans as the financial landscape shifts. In this chapter, we'll break down what this means for borrowing, saving, investing, and the risks ahead, so you can make informed choices, not just react to headlines. The goal isn't to scare you, but to prepare you. With the right information, you can take control of your financial future, no matter what the Fed decides. In today's world, being in control of your finances isn't just a good idea, it's a necessity. The more you know, the better you can plan, adapt, and thrive. So consider this your financial wake-up call, a chance to get ahead, stay informed, and make your money work for you in the months to come. Why is the Fed cutting rates now? It's a question on the minds of economists, business owners, and everyday Americans alike. The answer isn't simple, but it's rooted in the Federal Reserve's core responsibilities and the current state of the economy. It comes down to their dual mandate: keep inflation in check and maximize employment. These two goals often pull in opposite directions, and right now, the Fed is feeling the pressure from both sides. The job market is showing cracks. Unemployment is up to 4.3%, a 4-year high. For millions of Americans, that means finding work is getting harder, and job security is slipping away. Recent revisions revealed the economy created nearly 1 million fewer jobs than we thought. That's not just a number. It's a sign that the labor market is weaker than it appeared, and that could have ripple effects across the country. That's a big warning sign for the Fed. When job growth slows and unemployment rises, it can signal deeper problems ahead, like falling consumer confidence and shrinking business investment. If people aren't working, they aren't spending, and the economy slows. Businesses see fewer customers, and communities feel the pinch as local shops close their doors. The Fed is acting now to prevent a deeper downturn or recession. By lowering rates, they hope to make borrowing cheaper, encourage businesses to hire, and keep the economy moving forward. But here's the catch. Inflation is still high at 2.9%, above the Fed's 2% target. Prices for groceries, gas, and everyday essentials remain stubbornly elevated, squeezing household budgets. So, the Fed faces a tough choice: fight inflation or support jobs. Each path carries risks, and the wrong move could make things worse for families and businesses. By signaling a rate cut, they're betting that stimulating hiring is more urgent than cooling prices. The hope is that a stronger job market will eventually help ease inflation rather than the other way around. It's a calculated risk. Cut rates to boost jobs, but hope inflation doesn't spiral. The Fed knows that if they move too fast, prices could surge even higher, but if they wait too long, the job market could deteriorate further. The Fed is walking a tightrope, and the outcome will affect us all. Every decision they make ripples through the economy, touching everything from paychecks to mortgage rates. If they get it right, the economy stabilizes. People keep their jobs, businesses grow, and families can plan for the future with more confidence. If not, we could face bigger problems ahead: higher unemployment, more business closures, and a longer road to recovery. This is the balancing act at the heart of today's decision. The stakes are high, and the choices made now will shape the economic landscape for months, if not years, to come. What does a rate cut mean for you? When the Federal Reserve lowers interest rates, it's not just a headline. It's a shift that can ripple through your entire financial life. Whether you're a seasoned investor or just starting out, these changes can affect your wallet in more ways than you might expect. In short, borrowing gets cheaper. Banks and lenders typically respond to a rate cut by lowering the interest rates they charge on loans and credit products. This means you could pay less to borrow money for big purchases or to cover unexpected expenses. Credit card APRs, auto loans, and personal loans will likely see lower rates soon. If you've been putting off a major purchase or considering refinancing, this could be your moment to act. If you're carrying debt, even a small drop in rates can ease your monthly payments. Over time, that can add up to real savings, freeing up cash for other priorities or helping you pay down balances faster. Thinking of buying a car or consolidating debt? Now's a good time to shop for loans. Lenders may compete more aggressively for your business, so compare offers and negotiate for the best terms. Mortgages are a bit more complex. They're tied to the 10-year Treasury yield, not just the Fed's rate. Still, lower rates can make homeownership more affordable, especially if you're looking to refinance or buy your first home. Markets often anticipate rate cuts, so mortgage rates may have already dipped. If you're in the market, keep an eye on trends and act quickly if you spot a favorable rate. Still, lower borrowing costs can save you thousands over the life of a loan. Even a fraction of a percentage point can make a big difference over 15 or 30 years. But don't get carried away. Cheaper money can fuel a frenzy, especially in housing. When borrowing is easier, demand can surge, pushing prices higher and making competition fierce. Use this opportunity to strengthen your finances, not to overspend. Take a close look at your budget and make sure any new debt fits comfortably within your means. Consider locking in lower rates if you can, and don't be afraid to ask lenders about special promotions or discounts that may be available during this period. A rate cut is a chance to improve your situation, not a free pass to take on more debt. Be cautious about taking on obligations you can't manage, even if the rates seem attractive. Be smart, borrow wisely, and stay focused on your long-term goals. Use this moment to review your financial plan and make adjustments that set you up for future success. The Fed's move is your cue to act with intention. Take advantage of lower rates, but always keep your financial health front and center as you make decisions. Lower mortgage rates sound like a dream for home buyers. A small drop in rates can save you hundreds each month. But here's the catch. Cheaper mortgages bring more buyers into the market. More buyers, same number of homes, prices get pushed up. Bidding wars can wipe out the savings from lower rates. First-time buyers may find homes even less affordable. The very thing meant to help can make it harder to buy. If you're house hunting, know your budget and stick to it. Don't get swept up in the frenzy or overpay. Sometimes waiting is the smartest move. The right home is one you can truly afford. Savers, this is the tough part. A Fed rate cut means banks will pay you less interest on your savings. Those high-yield accounts? Expect rates to drop. With inflation at 2.9%, your real returns shrink even more. Your money is barely keeping up with rising prices. This is the saver's dilemma. Be safe and earn less, or take more risk for better returns. Don't panic. Keep your emergency funds safe and accessible. But for extra cash, consider locking in longer-term CDs before rates fall further, or talk to a financial advisor about investing for the long term. A rate cut is a signal. You can't be passive with your savings anymore. Protect your future by being proactive. Don't let your hard-earned money quietly lose value. Make your cash work smarter, not just harder. Investors, you might be celebrating. Lower rates often push people out of savings and into the stock market. More demand for stocks can drive prices up. Good news for your 401k or IRA. Companies also benefit. Cheaper borrowing can boost profits and stock values. But don't get complacent. A rate cut is also a warning sign about the economy. If growth stalls, markets can turn quickly. Stick to your long-term plan, stay diversified, and keep contributing. Enjoy the gains, but be ready for volatility. Smart investors prepare for both sunny and rainy days. The big risk? Inflation. Cutting rates can boost spending, but if supply can't keep up, prices rise even faster. The Fed hopes a small cut will help jobs without unleashing runaway inflation. It's a high-stakes gamble. Get it right, and the economy stabilizes. Get it wrong, and we could face stagflation, slow growth, and high prices. The Fed argues rates are still high enough to keep inflation in check, but if they misjudge, everyone pays the price at the grocery store, gas pump, and beyond. This is why the decision is so controversial. The Fed is threading a needle, and the stakes couldn't be higher. We're all watching to see if they can pull it off. The cost of failure is real for every American. Who wins and who loses when rates drop? Winners, borrowers with debt, corporations needing cheap loans, and investors as stocks often rise. Sellers in the housing market can also benefit from more buyers. Losers, savers, who see their interest income shrink, and first-time homebuyers who may be priced out. Retirees relying on savings are hit especially hard. If inflation rises, everyone feels the pain, especially those on tight budgets. The Fed's move helps some, but it's a trade-off. Know which side you're on and plan accordingly. In this new landscape, awareness is your best defense. The Fed has acted, now it's your turn. If you have high-interest debt, use this window to pay it down or refinance. Savers, review your cash strategy. Keep your emergency funds safe, but look for better returns on extra cash. Homebuyers, don't let low rates push you into overpaying. Focus on what you can truly afford. Car shoppers, get pre-approved and don't be lured by low rates alone. Most importantly, watch the unemployment and inflation rates in the coming months. These numbers will show if the Fed's gamble is working. Stay informed, but don't let headlines drive your decisions. Stick to the basics. Live below your means, pay off debt, save, and invest for the long term. The financial world is changing, but smart habits never go out of style. Be proactive, not reactive. That's how you stay strong, smart, and secure, no matter what the Fed does next.